Go to Microsoft real quick. And this is a fascinating alternative to sort of so let's look at Microsoft's annual price from 2000. Let's see, 2020. Let's start with 1999. And this was the bubble days, and you can see that Microsoft stock has finally recovered. Finally recovered, even though its financial condition is quite a bit different. And this happens in every industry. It actually happened with Johnson & Johnson. The markets can I wouldn't say they can have their own imagination. They do have their own imagination. They do have their own implicit opinion. It's sort of consensus opinion that occurs through this sort of groupthink, if you will, or mind, sort of all the minds of the market aligning it as one. And here we go. You can see Microsoft sort of round-tripping from 58, 1999, 17 years ago. I remember sitting there looking at Microsoft stock at $70. That was the end of the year. It was 70 earlier that year. Or in fact, it was 70 in 2000. And you can see it dropping to 21, staying in the 20s and 30s for a long time, and finally just recovering in the last few years. Now, what about its financial condition over the same period of time? Well, you can see that the revenue in 2004 was $37 billion, and the revenue now is $93 billion. But the stock price was actually higher at one point with much lower revenue. We can go to Microsoft real quick and grab some filings. It won't take very long. And you'll be amazed at how the market can anticipate that high growth companies are fairly valued by the market exceptionally quickly. Fiscal year 2002, 28,365, 32,187, 36,835. So if you just pick 2 years, like that doesn't look right. I got these backwards. 28,365, 32,187, 36,835. There we go. Almost done. Let's go to 5. And you might be saying, well, this is just due to the bubble, but I don't think that's accurate. This happens quite often. It happens in pharmaceuticals all the time. Let me show you exactly what I mean. Wrong number for 2006. 448 282 6835. It's kind of funky. Look at these some typos here. All right. One more. It's great the SEC filings go back this far, and they're even hyperlinked. Here we go, 22,956. All right. So you can see what's amazing about Microsoft is they've had revenue growth every year. Every year. I mean, maybe 1 year where they had negative revenue drop. 1 year. Every single year. And you can see the revenue growth has been consistent. You might think that, well, the market can get things wrong with companies that have revenue jumping up and down, right? But here you have the company with $25 billion in revenue and a $33 stock price, and literally a decade later, 11 years later, the same stock price, the same stock price, with 73 billion in revenue, triple the size of the company. And a lot of this has to do with our important aspects like discount rate and sort of theoretical growth, which we of course annually we put in annually, and then of course maturity, growth at maturity, and of course return on invested capital. These are sort of three core concepts. Let me just say near-term earnings here, growth at maturity. And so the market is always keeping these things in mind, these four things in mind. And here in 2001, if you could talk to the market, what the market would say is, well, I think Microsoft is the only game in town. There's no risk. Near-term earnings look great. Growth at maturity, well, the internet's just starting. It's going to be here forever. What a wonderful company. And that's why they were willing to ascribe such a high valuation to it. And of course, if you could talk to the market in 2012, literally 11 years later, it has a lower stock price. So could you imagine buying something in 2001 and then being told that not only did you lose money in 2012, you're down on your investment, but the company's results have been amazing. Amazing. So this is post-crash. This is 2011. I'm not even worried about 1999-2000 when the market crashed. This is post-crash. So the market is really basically saying in 2012 that the discount rate is higher than it was in 2001. There's more risks to the long-term earnings of Microsoft. Maybe that's due to Apple and mobile, whereas Microsoft in 2001, nobody could envision how much success Apple and the mobile platforms would have. People thought of cell phones as cell phones, not as future kind of replacements for PCs. So Microsoft started here with just operating systems and information worker, we'll call those two. And here it's sort of left with information worker. So that's sort of an interesting sort of concept. So the discount rate seems higher. Near-term earnings seem fine. I don't know that there's any difference between. In fact, you can see the growth is great at Microsoft. But at maturity, we wonder, is this a more mature company, etc. And return on invested capital, well, we'll see if the new CEO can make things work. But again, the concept that you finally have equalized the stock price of 1999, but you only had to grow the company by 5-fold. The market was really smart at expecting the success of Microsoft. The stock price did not grow like the earnings grew. In fact, the stock price was basically flat, while the revenue and the earnings grew dramatically. So you can see here the average stock price growth was very low, while the revenue and success of the company was very high. And this will happen very frequently.